Friends, I will talk to you now about the history of Indian financial system, the stages at which the financial system has actually undergone a major reformation, the pre-independent stage, the post-independent stage, and post-1991 stages mainly. See, today India has a fairly good and effective financial system. No doubt, as a country, we have taken a significant amount of time, a very long time, in fact, to reach this stage. We are still struggling to come out of the hangover of the socialist era, and if the present structure of the Indian financial system, if it gains full momentum, our country can really achieve the aim of prosperity for all. See, the well developed and efficient financial system, it is very much required for any economy, for any country. As an ancient civilization, the India always had some rudimentary form of financial system, some primitive form of the financial system. The financial system has intermediaries, it has financial markets, it has instruments, and it has regulators, means regulatory bodies. The financial system, it has intermediaries who function in the financial markets with the help of the instruments, and the regulators or the regulatory authorities or the bodies, they regulate the business activities of the intermediaries. However, as the time moved, the Indian subcontinent lost pace with the world in terms of socio-economic development. The pre-independence era, especially the period from 1857 to 1947, it had a mixed bag of financial system. And in this era, the financial system was highly informal with elementary financial market structures. And the financial intermediaries, they took some shape, but the capital flow for long-term financing was non-existent during this period. But after independence, the political leadership favored the socialist ideals and they undertook an approach of planned economic development. So, this approach needed the distribution of financial resources under the government control. So, this need for control it resulted in the public ownership of financial institutions, starting with the Reserve Bank of India, which was established in 1935, was nationalized in 1949. In the year 1956, the Imperial Bank became the State Bank of India. And in the same year, 1956, the political leadership nationalized 245 insurance companies and the provident societies to create the life insurance company LIC of India. And in the year 1969, they nationalized 14 banks. The year 1980, government nationalized 6 more banks. So this era also witnessed the establishment of government-controlled new institutions like the Unit Trust of India in 1964, which gave birth to the mutual fund industry in the country. So the government-controlled insurance industry and the establishment of the General Insurance Corporation GIC in the year 1972. So there were these special features of this the economy during this period or the Indian financial control or the system during that period. So this state controlled financial system, it dominated the economy with the establishment of various financial institutions, including the development finance institutions, DFIs, like the Industrial Finance Corporation of India, IFCI, in the year 1948, and the state finance corporations at the state level. Another most significant event was the establishment of Industrial Credit and Investment Corporation Limited, ICICI. It was not a bank till then, as an initiative of the Government of India and the World Bank. So during these times, the Indian financial system saw a significant development in terms of the compliance frameworks, operational policy, the legal structures that strengthened the financial system further. So some notable development on the legal structure front was the Capital Issue Control Act 1947, Companies Act 1956, Security Contract Act 1956, the Monopoly Restriction and Trade Practice Act 1970, and the Foreign Exchange Regulation Act 1973, FERA 1973. So this resulted in the financial system taking a diversified, distinct structures to serve the planned economy approach. So this pre-1991 state-owned means the government-owned Indian financial system, it had a flaw, it had a defect for efficient sourcing, management, and for the distribution of the capital. So it was a DFI dominated structure for industrial financing where sourcing of fund was the state sponsor dependent one rather than the institutionalization of the public saving. So this erroneous organization of the intermediaries, it had a relatively limited financing scope. It gave rise to various disorders like political industrial nexus and the lopsided capital structure of the invested companies, that is high debt to equity, lesser promoter risk, low capital risk, the high probability of default, so on and so forth. So this defective structure it blocked out the participation of the public, the masses, and also the SMEs, the small and medium scale enterprises. So there were certain plus points also in the system like the process orientation, the dependency reduction, and the development of a newer type of industry under the mandate of the state. In Indian financial system, there was a wave of transformation after the financial crisis or the BOP crisis of 1991 and consequent liberalization of the economy. So the post 1991 Indian political leadership adopted the ideals of a liberal market economy, and this adoption of the market led approach is started reduction in the state control, the government control over the financial system. And the government also started accepting the role of a facilitator, a regulator, or a reformer than the owner of financial intermediaries and markets. So this change it started a reorganization of the financial system at a fundamental level, and the political leadership established three new regulatory bodies after 1991. The bodies like SEBI, established in 1992, and a statutory status was given. Then the IRDAI, established in 1999, and the PFRDA, established in 2003. So the government opened up the financial system and markets for the private players. It attracted the private investors to some existing DFIs like the IFCI and IDBI. So as state control was in decline, and consequently it also reduced the dominance of the DFIs on financial system, A significant change came into being with the establishment of ICICI Bank Limited. Earlier it was only ICICI Limited. So this was merged with the subsidiary, and the government also took initiative and converted the IDBI into a commercial bank, and Industrial Investment Bank of India IIBI established in 1971. So it was also this what was established in 1971, it was also closed down in 2006. So the banking system saw significant transformation with the entry of the private and foreign players. RBI also played a key role in the facilitation of the NBFC sector. So this has resulted in the diversity of the financial system and catered to various discrete needs of the markets. The role of RBI is notable in the transformation of banking system as a regulator. And autonomy of RBI was one key factor in this transformation. So the industry engagement with the capital market it began to improve, and several important institutions like the National Stock Exchange Limited (NSE) established in 92, started operations in 1994. Stock Holding Corporation of India, ICICI Securities and Finance Limited, it came into being, established in 1995, and it started an electronic brokerage platform in 2000. So security markets as part of the Indian financial system, it witnessed a significant transformation under the purview of SEBI. Specialist market intermediaries for the facilitation of new issues started playing key roles in the primary market. The wave of transformation also hit the secondary market. In the year 1992, NSE introduced screen-based trading. So this disruptive introduction, it changed the secondary market interaction with greater transparency and liquidity. Another major remarkable change was the enactment of the Depository Act 1996 and the setting up of two depositors, namely the National Securities Depository Limited NSDL established in 1996 and the Central Depository Services Limited CDSL in 1999. So NSDL and CDSL they have dematerialized almost all the traded shares, and transfer of ownership is done through the book entry system now, no physical transfer. One notable event was the commencement of the derivative trading in India, which started in the year 2001. So two sectors that need their due credit, they are the insurance and the mutual fund. And the post 1991 period, it was especially good for these two sectors. Various national and foreign entities beginning to participate in the mutual fund sector led to the diversification of this sector. So under the regulatory purview of IRDA, the insurance sector has become a much more disciplined and dynamic sector with the participation of national and foreign players. And this sector with a highly diversified product portfolio with a much wider inclusion of customers, it has also strengthened the financial system in India. The post 1991 era transformed the Indian financial system with a newer type of organizational structure like credit rating agencies, technical consultancies, the custodian service providers, the portfolio managers, foreign institutional investors, which has all brought much needed dynamism in the economy of the country during post 1991 with some more minor markups. Further, with some more minor modifications to the existing system now and then is doing well. So let me end up with this. Thank you, friends.